From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, December 3rd. You're listening to the Macrocast on another all-important non-farm payrolls day. It's Jobs Day. We had the payroll announcement earlier this morning. This is Tony Fratto with Hamilton Place Strategies. We've got Brendan Walsh and John Fagan with Markets Policy Partners, and Stratton Kirton sitting in with us today from Hamilton Place Strategies to help us get through this employment situation report morning. Stratton, why don't you take us through the numbers, because I think there's just like so much to dive into in these surveys this morning. So why don't you level set us with the numbers, and then we'll go from there.
Yeah, absolutely. Thanks for having me. So, what everybody's paying attention to is that the job gains missed expectations. Expectations were about 573,000 in gains. What we actually saw come in from the employment survey is 210,000 non-farm payroll jobs. Some of the positives, which this is where some of the headlines are going, is the unemployment rate took a big drop to 4.2%. We saw total unemployment come down to 6.5 million people, which is, about 5.7 million pre-COVID levels. Average annual earnings are up almost 5%, 4.8%. Some of the negatives of the report, setting aside the weirdness with, the divergence in jobs created versus the unemployment rate, long-term unemployment was still stuck at 2.2 million, and we're about 82% recovered, which means we still have a pretty long ways to go. And at the current rate, we're about a year out, maybe 10 to 11 months if we keep creating at this level. But, like I said, the real top line that people are focusing on is, why did we miss expectations? Why, with only 210,000 jobs created, did we actually see a big drop in the unemployment rate? Which I think is what we're probably going to talk about first.
What was and what was the participation rate, Stratton?
It was just shy of 62%. I think it was 61.8%, somewhere
around.
Still
down. Yeah, so
yeah, it's still down more than 1% from pre-COVID levels.
Yeah, correct. 61.8%.
Yeah, so no improvement there. It's sort of fell off in COVID and stayed at right around that 62% number, or just below it it's been a long time now, actually.
And I don't know if this is too sweeping of a statement to say, but it kind of seems like things are pointing in the direction of maybe the sort of low-hanging fruit in terms of recovery has been picked, and now we're getting into the stuff that's a little harder, where people have been out of work for a while, and we know it just takes a whole lot more to get them back into the workforce.
Yeah, and you still have 1.5 million women that are out of the labor force, and that's heavily Black and Latino women. And when you look at education and daycare work, they have very much lagged the recovery in jobs. They're still down I think education is down about 6% from the peaks, and daycare is down almost 11%.
Well, in even this month, you didn't see a lot of sectors where they actually lost jobs. But to your point, daycare and gray care, so nursing homes, both lost jobs in the sector, which is kind of, a little bit shocking if you think about what a hit they took, in the last months. And
retail. So this is the employment, the establishment survey. So this is from talking to actual companies. But the retail sector was down almost 21,000 jobs, and this is in November, when you're ramping up to hire for the holiday spending season.
I think that's all to say. Actually, did you mention the revisions, Stratton?
No, I didn't.
So I think roughly 85,000. Over the previous 2 months.
I think it was 60 and 15 or so between the two of them.
Yeah, and of course, those were revisions on top of revisions.
Exactly.
For the September period, so which had big revisions in the October report. So there is our friend Steve Leisman over at CNBC said that this morning. They're like, we're big. I'm a big backer of BLS. And there's a lot of BS about the work that BLS does. And so let me stipulate by saying the Bureau of Labor Statistics are the finest counters and estimators of job creation on the planet. They're the very best at this. They're really, really good at it. And it is really hard to do, if in a very big economy, to do the modeling, the seasonality, to get those things right is really, really challenging. It's especially challenging when you have really idiosyncratic things and big shifts happening in labor markets. It's hard to model. We have to remember that these are not simply counting. These are estimates based on models. And with the monthly job creation numbers in the establishment survey. So that requires estimates, modeling. How many jobs, by modeling, if you're not familiar with this, it's how many jobs ought to be created this month? How many jobs do we expect in a normal year to be created this month? Then with some adjustments, given what we think is happening with the economy and seasonality, like, back to school or retail jobs because of the holiday shopping season, or farm workers because of harvest season. All of these things are seasonality kinds of things that happen, and BLS makes adjustments. My point is, it's really hard to make adjustments when you've got people shifting from one sector of the economy to another sector of the economy, shifting from services to goods, from goods back to services, from people being out of the transportation, hospitality, and leisure section, moving back into the transportation, hospitality, and leisure sector, and then basing it off of a year of, looking back at 2020, which was a COVID year. And, it's really hard to do, and population size and estimating workforce participation. So that's all to say, in a very long-winded way, that they've got a challenging job. And then I could say, and they've missed the mark. We've seen it with the very large revisions in previous months. And I don't believe this number this month. I think we're going to see upward revisions on 210. I don't think that they're going to get to what the market expected in the 500,000 plus range, but I would not be surprised if 2 months from now, we're not looking back at the October jobs numbers and seeing that number above 300,000, not this 210,000. I would not be surprised at all.
Yeah, absolutely. I think the other thing that's important to remember is just context, right? I remember in 2009 being a staffer on the Hill for a member, a Democratic member. And, if you think about like the jobs reports that President Biden has seen since he's taken office, I think the Obama administration would have killed to have, this job creation record in their first year. We saw wild swings, including job losses, still happening in the first year of the Obama administration. So while 210 is not the expectations, it's still, like you said, if we're expecting upward revisions, puts them on a good path for by the time they go into their next election in the midterms to be able to say, we have like fully recovered from COVID in the last 2 years.
Yeah, and it really does create this sort of Rorschach test kind of dynamic when you're looking at the number as something for everybody, obviously. And if you've got a hawkish bent, which the Fed, and we'll talk a little bit more about that later in the show, but if you've got a hawkish bent, you can certainly find plenty of justification within these figures. And but on the other side, we actually saw the equity futures pop upward. That is, in bad news is good news, or a Goldilocks kind of formulation that we've seen time and time again, which is, if the data isn't as strong as expected, that might stay the Fed's hand in terms of withdrawal or at least accelerating withdrawal of of accommodation through the asset purchase program, et cetera. So it's a nuanced reaction in financial markets. Treasuries really aren't reacting that much, I think, because just what you were both saying, which is that this number isn't, the headline grabber isn't really the full story here, and the Fed will find plenty of justification if it's fixated on inflation fighting too.
Yeah, it's kind of hard to say, right? You have to do. You're basically, this number is not providing clarity if a lot of people are out there saying, "Hey, we don't believe the number," right? Now, I think the participation rate is real, and I think the unemployment rate is real. But we also learned that in the pre-COVID period, when we thought we were probably tapped out in job creation, that people who we thought were out of the economy actually were able to be pulled back into the economy. So we don't actually know that either, whether the 4.2% is real or not. We don't know of the, Brendan, the women in the workforce that we talked about. We don't know if it's a demographic shift or if the specific categories that you're talking about, it's really hard for them to go back to work. Right. Because, if you're in downtown DC and you get on a bus heading to Columbia Heights at 11 o'clock in the evening, if that bus is running for these women, you'll get on a bus that is overwhelmingly Black and Latina women who are, going home from having cleaned the offices. That is a fact. You can see it, and so if people aren't going into the offices, you don't need cleaning women to come and do the cleaning. And so you have these sort of situations in the economy that are structural and also idiosyncratic to the workforce that are overrepresented by women that we don't know whether how that's going to turn around. And so that may continue to lag for a long time, but it may not, right? If people come back to the office, you'll see them coming back in.
Yeah, and interesting, we got the Canadian jobs report at the same time. So Canada is now 198,000 jobs above their pre-pandemic level. So they've completely recovered and are back to growth, while we're still, millions of jobs below where we were a year and a half ago.
That's pretty impressive. I didn't realize they were quite that strong.
I didn't realize it until today too.
Canadians always surprise you.
Yeah. Yeah. So they had a very strong November jobs report, and they have been too.
What did the loonie do?
It strengthened.
I'm betting the loonie strengthened. Well, I don't know what the dollar did either, but I think the dollar was probably steady also. If you said credit markets are steady, right, John?
Yeah, actually, we're seeing a little bit of dollar weakness, some of it is that we've got about half a percentage point against the Canadian dollar, which figures heavily into all the dollar indexes. But the U.S. dollar has actually been pretty strong. Not violently so, no big swings, pretty low volatility. But the sort of creeping incremental hawkishness, the outperformance of the U.S. economy, that's been bringing the dollar up and up to multi-month highs. So nothing eye-watering, but certainly.
Yeah, but that's what you want. I mean, those are the good reasons for dollar strength, right? Okay. Which by the way should be good for on the inflation front as well.
Yeah. And usually the stronger the dollar, commodity prices, oil in particular, very negatively correlated with the strength of the dollar. And oil prices are not, it wasn't just the dollar strength, but oil prices are down a lot over the past few weeks.
So if we were, let's assume that whatever it is, so the market was expecting, 500 to 530,000 jobs. It's an undershoot. I don't think the revisions are going to plus up that number by 200,000 or 300,000 jobs. So the thing that we can say is that it's not super hot, right? I mean, if that number had come in above 500,000, we would have seen that as hot. We would have seen that as inflation pressure. We don't get that story out of this, right?
That's certainly the way that the markets have it. As mentioned before, the Goldilocks, not too hot, not too cold, probably will get revised up, but maybe not as eye-wateringly fast as people expected. And then you have a situation where it breathes a little bit of reflationary dynamic into the financial market. So that's where we are today. But the bond market is definitely steadier. The bond market is skeptical that this really changes anything for the Fed at this point.
Yeah, and I think that's the right reading.
HPS affiliate Flag Media Analytics is a next-generation media monitoring firm designed to shorten the decision-making process for public affairs professionals. Our expert analysts will work with your team to ensure only the most relevant content reaches their inbox and provide custom metrics solutions for the evolving news cycle. To learn more about how Flag can get you ahead of the cycle, visit flagmediaanalytics.com.
I'm going to shift to Chairman Powell and Secretary Yellen testifying this week. And they, and Powell made a little bit of news, right? I mean, maybe we should.
He caught the markets off guard. They were not. We always talk about these testimonies, and you go up there to say nothing. Powell actually said something.
It was the strangest thing. I was like, I've never, but I think it was well done. It was well choreographed on his part. He made the comment about transitory, jettisoning transitory. Transitory is not what you thought it was, and so we're no longer transitory. And so in a recalibration, I think, of his outlook a little bit on tapering, right? I mean, the sense that he told the Hill, but really he was talking to markets that they are going to consider, they're going to have discussions about tapering, speeding along tapering, and presumably bringing the rate discussions forward as well. And the market heard them, right?
Yeah, it heard it loud and clear. It was a bit of a whiplash kind of situation, because the markets were coming into this testimony having just been gripped on the Friday after Thanksgiving with fear over the latest COVID variant, Omicron, or however you pronounce it. And we saw some very steep and downbeat market reactions to that news on Friday. It's of course that's going to be magnified by the illiquid, half day trading, just after the holiday, that sort of thing. So you don't want to read too much into it, but it was a pretty nasty day, and we got some follow through, a little bit of stabilization, but there was a sense that the Fed would take a look at this new variant and use that as we've seen this movie before. It's uncertainty. We don't know how it's going to impact the economy. And so the idea coming into the week was that the Fed is just going to hold steady, just stay the course. But Chair Powell did quite a hawkish swerve by retiring transitory, by focusing much more on inflation, casting doubt on, the idea of that the Fed can really stick the landing on getting full employment here. There was even allusions to that kind of, uncertainty on that side of things. And this was despite, these now renewed growth fears over the latest wave. So, if you flash back to September, essentially, to oversimplify, the Fed in September was saying, we've got this Delta wave, it's impacting the economy, so we need to probably stay more accommodative for longer. Now the Fed appears to be saying, and it's not just Chair Powell, it's a bunch of the other speakers as well. The Fed appears to be saying, we've got the Omicron wave coming, and it's going to impact the economy, and therefore we have to hasten our withdrawal of accommodation. It's a very, very different formulation.
Yes, seems like you have sort of like cross messages going on here, where if it's your view that the Fed was late in moderating support. And that is the view of a bunch of loud people right now. It doesn't sound right, No,
I'm with you. So Mester this morning said that she expects Omicron to constrict the supply chain, which will be inflationary because demand in the U.S. is still strong. So we have to start tightening. So basically, what she's saying is we need to slow the economy so that people don't buy things, which will decrease inflation on other things, because China and Vietnam can't produce things fast enough. That seems like a terrible way to conduct monetary policy.
I think
if I'm an American citizen.
Yeah, and I'm not sure that I'm not like I saw that also, and I'm not sure where what the logic is on it. Also, I also am not really sure it reflects. Let's just talk about just purely about supply chains. There's a lot of other stuff to talk about, but just purely on supply chain. The supply chain seems to be getting better. So yes, I understand Omicron is coming, but the supply chains are improving. Like waits at the ports are going down, not up. Yep. And so a lot of these things, is it possible that, I guess if you think that Omicron Omicron.
No.
You have a reading on this?
I'm going with Omicron.
Omicron? Okay. Omicron. That's what I'm going. I'm going Valley Girl. Omicron.
Yeah.
And,
well, we skipped new because we didn't want people to think it was NEW. And then the next one is she. And we skipped she because I know the previous administration definitely would not have skipped she.
Because it's a common surname.
Right. Okay,
but
so
yeah, Omicron.
Yeah, I guess our relations with China have improved because we skipped the she variant.
Just a bit.
New York Fed President Williams said, okay, well, Omicron is going to come in and start. He said exactly the same thing as Mester. Omicron is going to come in. It's going to basically re-entangle the global supply chains. It's going to cause problems. That's going to be inflationary. So we need to think about, and it's going to be bad. Which is bad for growth. But we now have to tighten monetary policy into a worse economic outcome because of inflation. I think it puts a lot of emphasis on kind of inflation expectations, as you know, and a potential wage price spiral. That's the kind of commentary that's justifying and backing up this push toward an accelerated taper. But it really does seem this is a very big pivot from where they were just at the center of the committee appeared to be just a month ago.
Yeah, I wonder if it's not a reading of where the supply chain was last year, not because of congestion at the ports or anything like that. So, I can see the argument of, we saw these regional lockdowns, in South Korea, China, Vietnam, when they had sort of like close to COVID zero policies, and really tried to stamp things out. But I mean, there's a lot of domestic pressure in these countries, particularly China right now, where all indications seem like growth has slowed even way more than what they're publicly reporting. So it's hard to see if like that is true, that speaking of that we're going to have, big, massive lockdowns in China again, even if we see Omicron pop up there.
Yeah, and I think it's look. I hope I'm thinking with my head and not my heart on this, because I don't want to see lockdowns again. And I don't think lockdowns are going to be necessary, and so I don't think lockdowns are coming either. And I think we do have vaccines. We do have FDA came out this morning indicating that they are going to treat future COVID vaccines in exactly the same way they treat flu vaccines, which is you don't have to go back and do the brand new clinical trials for the vaccine.
Yeah.
You can make tweaks and adjustments based on what you see in the new variant, and that will speed along the availability of vaccines. And there has to be some presumption that the existing vaccines still have some value, and the question is not whether, the question is how much, right? We know that there are very, very strong reasons to believe it's going to have some efficacy against the new variants. It may have a lot, or it may have very little. South Africa isn't the place to test that because they have very low levels of very low vaccination rates. So, and we don't know exactly even what all, which vaccines they're using. And so, look, it's all to say, first of all, everyone should go get vaccinated and go get boosted and get ready for the next one whenever it comes. But my point is that if you're Meister and you're looking at this and you say, well, this is going to happen again, it's like, I guess you want to be protected against it happening again. And that will pull back the horns of some people who were ready to go off like a bull. But I don't think we're not looking at shutdowns and lockdowns, and like that is not coming, certainly not in the United States. And I think not in most other places as well. I mean, you have to account for the fact that we've learned a lot over the past.
That's a really important point.
Months. Yeah.
Both as from the national level, but also the individual level. You know if you're high risk. So if this is an outbreak, you should stay inside. But that doesn't mean the entire country has to stay inside this time again.
Yeah, and when it comes to supply chains, corporations are very hip to the fact that this is an issue, and policymakers are too. And that's part of the reason that we're seeing some degree of congestion being coming down into ports. it's a big focus now, and it's a problem that policymakers around the world have addressed and confronted. So we can see container rates coming down. We can see less congestion at the ports. Some of the main signifiers of inflation, whether it's 10-year or 5-year tips break evens, whether it's oil prices, those are all off a lot from recent peaks. And so there's maybe there's a sense that perhaps the Fed is oversteering into what was essentially kind of like a big inflation. It was a big inflationary burst, but it has the potential to be kind of a head fake.
It may end up being transitory.
Yeah, I mean, oil prices are a big signifier of people's of price pressures for people. It's right at the pump, and when just a month ago, oil prices were $20 a barrel higher than they are now. We've got oil prices at the U.S. benchmark WTI back in the 60s. That's not that's not particularly high. That's not particularly inflationary.
No. And I'll tell you, just in terms of where people are going, I mean, like I know we want to be careful about what sort of anecdotal stories, but I was in the Garden last night to see the Knicks and the Bulls. It's a sold out show, a sold out game. Like, we're not going back to to empty arenas. Like, those things are not happening unless, like, Omicron would have to be really really bad, or worse than what we've seen. But I just don't believe it, given all the things that we've learned on how to cope with with variants as they come. And remember, we did a lot of this opening even in the face of Delta. And
totally, yeah. No, I'm with you. I was talking to John and another friend yesterday about that very thing, where the market, it freaks out every time the Omicron comes up, but then 3 hours later you watch an ESPN basketball game to a sold out crowd. Like, we're not changing behavior.
Well, and to your point, I mean, again, anecdotal, but my oldest son is 5 years old, so was just eligible for the vaccine. Yep. Got his first vaccine within 3 or 4 days of eligibility, which meant last weekend he got his second. So that means that first wave of the 5 to 12 or 5 to 11, in the next 2 weeks, they're going to be fully vaccinated. So there's only going to be more people who are going to be fully vaccinated.
My sense is that we are going to come around to understanding that we're living with a coronavirus. Coronaviruses are going to mutate, and vaccines are going to become a bigger part of our regular part of our lives, and that's just the way it's going to be. And and I don't think we should be thankful that we've got the magic of medical science to to deal with these things. But I think it's going to become it's going to be diminishing impacts on our economic lives over time.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
You spoke about oil a little bit. We had a little OPEC news. Could we talk about sort of like just what is going on with oil? I mean, oil was coming down before the president did the really unprecedented, truly unprecedented, sale of oil from the Strategic Petroleum Reserve. And I say unprecedented in that it has never been done for purely, price manipulation reasons. And those sound like dirty words, right? But the oil was sold from the Strategic Petroleum Reserve to manipulate the price of oil because they thought oil prices were getting too high. It has been the only other times it's been sold, and it has been sold, numerous times in the past, but, during wars and during hurricanes and so when hurricanes shut down
for what it's actually
platforms in the Gulf, then you release some oil from the reserves, things like that. So natural disasters, wars, this is the first time it was ever done. It wasn't a lot with I don't think I think it was like it gave a maybe a little nudge to a snowball that was already heading downhill. And there was speculation as to what OPEC was going to do. And what did they do?
Yeah, there was a lot of speculation that OPEC would pause their rollback of supply curbs. This was the meeting that had followed two previous. They meet at the beginning of every month to decide the next month's production, and the preset pace that they have is reintroducing 400,000 barrels per day per month back into global supply from OPEC and their allies. And the preset, this was during the past 2 months when oil prices were, Brent crude was knocking on the door of $90 a barrel and trending strongly higher. And in the face of this was when the energy crunches in Europe and that were at the extreme. China was struggling to get power to its factories in the Northeast. This was a big issue. And OPEC over the summer had kind of been squabbling, actually having trouble finding unity. There was the UAE and some of the other smaller producers were pushing Saudi to reassess and give them a little bit more cap space, essentially to pump. And so coming into this, it looked as though in the fall there would be a window for OPEC to kind of do the Biden administration and Brussels and Beijing a solid and boost the reintroduction and accelerate their the pullback of these supply curbs. They did not. They formed a reunited front and dug in their heels basically at the beginning of October and November. And it was a very big, that led to a very big spike in oil prices that was already in that trend, but certainly accelerated it to the upside. And the Biden administration, obviously, as you said, responded with coordinated multi-nation strategic control. It wasn't just the U.S.; it was Japan, right. China did it. It was India, and the reality is it's the actual effect. It's kind of a drop in the bucket, but it's demonstration, and you have a situation in which OPEC was feeling some pressure, and they came into the meeting yesterday. And instead of pausing like everybody expected, they went ahead with it. They gave themselves a lot of wiggle room. We're going to watch Omicron, and if it starts to suppress demand, well, we'll be quick on the trigger to react to that. So it wasn't totally bearish for oil prices, but it was certainly not the kind of supportive action that most of the analysts had expected.
But it was bearish for global stability because the big reason that they decided to hold steady was Russia. And the big reason Russia did it is because they're about to fight a war in Ukraine and they need money.
Yeah, that's certainly what it looks like. Yeah. So there's definitely a sting in the tail, at least implied in the decision.
Stratton, are you on Ukraine watch?
I'm on Ukraine watch for many, many sad reasons. Yeah, I mean, it's tough. This is adjacent to obviously oil prices. It's also tough to predict, right? Because a lot of people are like, no logical, rational person would make this decision, right? But I mean, it's like Georgia, Crimea. I mean, you keep doing the same thing and you don't really get, that much pushback on it. What's your incentive not to do it, especially if it plays well domestically? I think I saw an article yesterday that said, caveats on how reliable public polling is in Russia, but that most Russians believe Ukrainians want to be liberated from the Kiev government. So not looking good.
No, but I would definitely have. I think it definitely would have. I think look, we always want to say the next one will have consequences. And I was in the White House when Crimea happened, and obviously here, but paying attention to. I'm sorry, to Georgia. It was Georgia when I was in the White House, and then Crimea, afterwards. And I think you're right. I mean, the international response was not sufficiently strong, and that's probably what Putin is calculating. I do think, a real land war in Ukraine would be in a different category, and it would be significant.
Yeah, I mean, I don't think you're going to see them marching all the way over to the western border, but do they take those sort of de facto breakaway regions that have been operating independently and fold them in? Probably. It gets them closer to a land connection to Crimea too.
So time to refill the strategic petroleum.
Yes, SPR.
Oil prices are in the 60s.
Yeah, we might need it.
Good time right now.
Yeah, actually, I was driving through Georgetown the other day, and I remember filling up at one of the gas stations. Remember, like a year ago, we had a gas shortage for like a day.
Yes.
Remember when we? I mean, it was not real, but just technical, technical negative on.
Yeah, we did negative. Yeah.
Yeah. Guys, any data for next week? I mean, it seems like I don't know. I never liked December numbers.
Next week is CPI. That's the big one next week. That's going to be drum roll, please, before that one comes out, as everyone tries to take bets on what the Fed's going to do with regard to the taper announcement at their December meeting. And today, as we talked about, today's labor numbers probably won't move the needle, but CPI could certainly cement, if it comes in hot, in the minds of the market, that would probably cement an accelerated taper, because the Fed is now obviously so fixated on inflation and sort of junked the full employment before rate hikes formulation.
Right, and it's the November CPI, so this drop in oil prices won't have anything to do with that number.
FOMC is 15th and 16th, somewhere around there, I guess.
Yep.
Yeah.
The RBA has a meeting also that's the only other significant central bank that has a meeting next week.
Yeah, Australia. Yeah, I mean, one of the most hawkish major central banks around the world has been the Bank of England. Now they've done something that the Fed may end up doing here, which is they're a little bit further along in their withdrawal of accommodation. They signaled a rate hike, then they totally shocked the market by signaling a rate hike at the November meeting, then didn't hike rates at the November meeting, wrong footing the market again. You could hear, if you listen, you can hear the shrieks of 1,000 hedge fund managers in Greenwich, Connecticut when that occurred. And it was some ugly day for global macro guys and gals. But the Fed may end up, and the most hawkish member of the committee came out this morning and said, Omicron he voted for a rate hike at the last meeting. And he said, I think we need to pause, wait and see what's going on. Whereas now the Fed has sort of grabbed the mantle as, leading the hawkish charge into the Omicron wave. So we'll see how it comes out in December.
Well, and maybe one more thing to note on OPEC too is one thing that folks noted was a little unusual was they voted to stay in session. So they're like in permanent session. So they can actually reverse their output decisions without having to formally meet again too. So
that's a really interesting point.
Yeah. So that could come at any time if they decide markets are heading in the wrong direction.
Excellent point. And I didn't realize they had done that. In fact, I didn't even realize that they could do that. So that's great. Stratton, thanks for joining us this week on the special employment situation report version of the Macrocast today. Guys, have a great weekend. We'll talk to you next week on the Macrocast.
Thank you for listening to the HPS Insights podcast, produced by Hamilton Place Strategies. For the latest updates, follow us on Twitter at HPS Insights and follow us on the web at hamiltonplacestrategies.com.